Okay, so in this section, we're going to discuss liabilities. And with liabilities, we'll talk about current liabilities, and then we'll talk about long-term liabilities, and then finally we'll finish it up with some liquidity and solvency analysis. So, current liabilities. To really understand current liabilities, let's talk about capital structure. And we should be somewhat familiar with this since we talked about it when we talked about like time value of money, net present value analysis, and all of that good stuff. So the capital structure is a mixture of liabilities and stockholders' equity. It's what the business uses. It's how they how they pay for their long-term assets, how they pay for projects, that kind of thing. Two ways that you can generate capital is through debt financing, where you borrow money from creditors, or equity financing, where you're going to get cash from stockholders. People are going to buy shares of your stock. Okay. The cost of financing associated with these two, we've talked about these already in this class, but this is just a refresher. When you sell debt, so when you sell bonds, the expectation from investors is that they will get interest revenue from you. For us, that's an expense. When we sell shares of our stock, when we sell percentage ownership in our company, the expectation from the new owners is that they get a return with dividends. Okay, so some examples of debt that include these following, but it's definitely not limited to these followings, are notes, leases, and bonds. We will talk about notes and bonds primarily. We won't really discuss leases in this class. Just know that leases are essentially give you a right to use an asset. So you lease your apartment, you now have a right to use that apartment. You lease a vehicle, you have the right to use that vehicle. Okay. So just as a reminder, liabilities are obligations of a company that transfer some economic benefit in the future, okay? Most of the time, when we talk about it, that economic benefit, that future benefit is going to be cash. These are things like accounts payable, notes payable, salaries payable. So I've bought inventory from a vendor on account. I've taken a loan out or signed a note from the bank. I owe my employees some salary for time that they've worked this month. There are other liabilities like the deferred revenue liability, that unearned service revenue, where the obligation or the benefit you're giving up is the fact that you have to transfer a good or a service to the customer in the future. Okay. Also, remember that there are current portions of long-term debt. So there is a current liability for long-term debt. So if you say take out a loan for 5 years and you pay $1 million a year towards that loan, then that first $1 million that's due this year is current, and the rest of the 4 is long-term. So notes payable, this is the first one we're going to talk about. These are a very formal contract that you sign. You sign a covenant with them saying we will repay you the principal, the money that we borrowed, plus any interest rate that you decide is fair. And that will just be the cost of borrowing that money. So you're going to pay the principal plus interest. Interest, again, is just the cost of borrowing money. That is an expense for us. Okay. The way that we calculate interest due on a note payable is we use our ART formula, the amount times the rate times the time. 100,000 times 10% times 6/12. Okay. That's how we're going to calculate it. So let's look at just recording the note payable. So this is going to be recording the issuance of the note payable. Okay, so let's say that Southwest borrows $100,000 from the Bank of America on September 1st, 2024. They sign a 6% 6-month note for the amount borrowed plus any accrued interest due on March 1st, 2025. So on March 1st, 2025, they're going to pay the principal plus any interest that is due. Okay, so on September 1st, 2024, they'll receive $100,000 in cash, and the following will be recorded. They increase their assets because they got cash for it, and they're going to increase a liability because they're going to remind themselves that, hey, we owe somebody this money. Now let's talk about recording the note, the interest payable that we're going to have. So if you recall, we took this loan out in September, and it's not due until March. This is going to cross 2 different years. So let's say that our reporting period ends on December 31st. How long did we have that loan? Well, we got it in September. So September, October, November, December, we had it for 4 months. So you take the 100,000 times the 6% times 4/12, that gives you $2,000 in expense. We've used the money, the principal, to help us generate revenue, so we have to recognize the expense. Notice here we increase interest expense by $2,000, which decreases net income and decreases retained earnings. But we're also going to increase the liability because we have not actually paid it yet. We are reminding ourselves that on March 1st, we will have to pay that money. Okay. So again, this is the way we calculated it: 100,000 times 6% times 4/12. We increase an expense because we're recognizing that we used it, and then we're going to increase a liability to recognize that we have to pay that cash in the future. Okay. So let's take a look at repayment of the note. This one gets a little more complicated because what we're recognizing is there is still some amount of interest that we haven't recognized the expense for that last month, that month of February, that we, January and February, that we didn't recognize the interest expense for. So same concept though, okay? We're going to repay the entire note payable. So that's $100,000, okay? We also have interest payable that we had built up of $2,000. That was in this last slide here, okay? So we know we have a liability of $2,000. We're going to decrease that because we're actually going to pay it, okay? And then we have retained earnings here. You can see it decreases by $1,000 because the expense that we're recognizing for the last 2 months has increased by $1,000. Total, we're giving out $103,000 in cash. So we have a net decrease of assets by $103,000 and a net decrease of liabilities and equity of the same amount. Your accounting equation still balances. Your credits equal your debits. You are good to go. Okay. Just note down here at the bottom, in regards to interest, you report interest expense in the period in which we incur it, the period in which we use it. So we're recording this interest expense every month. Okay. Let's talk about accounts payable really quickly. Accounts payable, these are very informal contracts, kind of. You're buying inventory from a vendor, and they say your credit's good enough that we will allow you to pay us the cash later. Okay. Sometimes you'll hear this called trade accounts payable. They are most often current liabilities. I will say that in this class, they will always be a current liability. Okay. You also have payroll liabilities. For a labor-intensive company, for a company that's manufacturing, like some of the stuff we've talked about with cost accounting in this class, this is going to be one of your most significant expenses, or one of your most significant accounts, one of your most significant payables. Okay, so the salaries payable, we talked about this. This is like you work Monday, Tuesday, Wednesday, and the month ends. But you don't get paid until that Friday. So you're going to have 3 days worth of payable. You're going to increase the expense by 3 days, and you're going to increase the payable by 3 days. So let's say you get paid $100 a day. We're going to create a $300 payable for Monday, Tuesday, Wednesday. We're going to create the $300 expense to recognize that your labor was used during those 3 days. Okay. One thing you have to be aware of, though, is that there are other payroll costs that we have to include. Things like federal and state unemployment taxes that employees don't see, but the employer has to pay. And also any FICA taxes, so Social Security, Medicare, Medicaid, that kind of thing. The employer has to match the contributions from the employee. Any contributions to health, disability, life insurance, retirement plans, all of those are included in your payroll liabilities. So other current liabilities that we talked about deferred revenue, right? This is your unearned service revenue. It's cash that you get cash before you perform the service. You still are obligated to perform a service. So in that case, the benefit or the resource that you are giving up is going to be that good or that service. You have sales tax payable. This is one that I saw a lot working in the government. When you go to somewhere like Target or Walmart and you pick something off the shelf that says $9.99, you go to the register and it's $9.27. Okay. It's because it's $10.27, excuse me. It's because you are paying sales tax for whatever municipality you're in, whatever state you're in, whatever the case is. Target does not get to keep that extra 28 cents. That goes into a liability account called sales tax payable, which will eventually be remitted back to the municipality or whatever government entity is levying that tax. We also have current portions of long-term debt. We talked about that a couple of minutes ago. So just be aware of those. Next video, we'll pick up with contingent liabilities.